Hello, my name is Chris Shea. I'm a financial advisor with BPS Financial Services, and this is a presentation today on understanding individual retirement accounts. The word IRA is thrown out there a lot. We'd like to give you an idea of where it came from and what it really is. So, what do you know or want to know and learn about individual retirement accounts? Go over the agenda a little bit. I'll introduce myself a little bit more. Ground rules, learn. If you got questions, reach out to me after the presentation's over. Ask them. Feel free to ask them. Love to be able to help you out so you can understand IRAs a little bit better. So with that, here are the objectives. What is an IRA? Going to go over the historical timeline, like I said, of the IRAs. Go through the types of IRAs. There's a lot more than you think. We can compare traditional versus Roth because that can be confusing to people. Then we'll go over the contribution limits for 2023. With that, let's get started. Again, my name is Chris Shea, financial advisor with BPS Financial Services. I'm a financial planning and implementation partner with my clients, meaning I help them come up with a plan and then I help them implement it, get them hopefully the results that they're looking for. First question is, what's an IRA? Well, it was established by the federal government. An IRA is an individual retirement account that's sole purpose is to encourage retirement savings. The government's encouraging you to save for retirement. This is a good thing. A little bit of the timeline, okay? It was introduced with the enactment of the ERISA, Employee Retirement Income Security Act of 1974, aka it's been around for a long time, nearly 50 years. Initially, the program was restricted IRAs to workers not covered by a qualified employment-based retirement plan, and the maximum contribution was $1,500. In the 1981, the Economic Recovery Act changed that, allowed all taxpayers under the age of 70 and a half to contribute to an IRA, regardless of their coverage under a qualified plan. So if you worked or didn't work, you could still contribute to an IRA. It also enabled a non-working spouse to make a contribution as well, $250. That was just to start. Got to start someplace. And the maximum contribution went up from $1,500 to $2,000. So as time's gone on, you can see there's a progress towards increased benefits, a spousal, and also increased contribution. There's a Tax Reform Act in 1986, which this reversed the trend of having higher earned workers covered by employee-based retirement plans, covered a spouse, phased out the deduction for them. If they've got enough money, they've got enough money. This is where some of those limits come in when you have a certain level of income. Small Business Job Protection Act 1996 raised the limit on behalf of non-working spouses from $250 to $2,000, aka you have the same limit as a non-working spouse as the working spouse does. Why was it different in the first place? I have no idea. It makes sense to have them be the same. And in 1997, the Roth IRA was created. And again, it was to encourage savings. And we'll go with it between a Roth and a traditional. But again, in 1997, the Roth IRA came into play. The timeline continues on. In 2001, the raise of contributions, and they also allowed a catch-up for people over the age of 50 because the government looked into their crystal ball and said, people aren't saving enough. When they're under 50, they've got challenges with family and paying for kids and all the stuff that comes along with that. When they're over 50, hopefully the kids are out of the house and they can start to contribute more. Let's give them the opportunity to contribute more. So they opened up that for ages 50 and above. Again, easier for high income taxpayers to do a Roth. And then in 2022, the changes included a phase out to traditional Roth contributions. Again, once you hit a certain income level, you're phased out of being able to contribute to an IRA. That's the history. Now, what types of IRAs are there? There's Roth, traditional, beneficiary, spousal, rollover, SEP, simple. A lot more than you thought. Let's go through it, because some of them are right for you and some of them may have no implication for you at all. Traditional IRA. This was the one first enacted in 1974 as part of the ERISA Act. You can see the tax advantage versus taxable chart on the left-hand side of putting money in. The tax advantage can result in a lot greater earnings and returns for you. Take advantage of it. Contributions are often tax deductible, again, based upon your income level. And all transactions and earnings within the IRA have no tax impact on your current year until the money's taken out. So if you have gains or losses, it doesn't matter if it's inside the IRA. All that matters is when you take the money out, you get taxed on it in a traditional account. The Roth IRA, contributions are made after tax, so they're considered an after-tax asset. They still go row with no tax implications. So again, you can see the chart, start off with nothing, make some investments, the same accounts, a little over $120,000 difference for the tax advantage versus the non-tax advantage. All transactions, again, in the IRA have no impact, and the withdrawals, for the most part, are tax-free. The reason for that is because you've been taxed when the money's gone into the Roth, and there's a thing in the United States called no double taxation. The government can't tax you twice. They're not going to. Beneficiary IRA. This is when someone passes away and leaves an IRA to an heir. There's always a beneficiary on a retirement account. They're required. So after they die, the beneficiary gets the IRA and they have to take the money out over a certain prescribed period of time. Depends upon rules. Any money that's taken out will contribute to their gross income for that year, but it allows for the money to be passed on to an heir. And again, you can see in the chart, it can be family members, it can be a beneficiary for a charity, a state, number of trusts it can go into. Lots of ways to have a beneficiary IRA come to someone. SEP IRA, simplified employee pension. Okay. It allows an employer to make a retirement contribution in an employee's name instead of to a pension fund. This is usually done for smaller companies. Again, it's a simplified employee pension. Again, mostly done for small companies with 1 or 2 employees. Simple IRA, savings, incentive, match plan for employees IRA. Again, this is very much similar to a 401k for a business, again, a small business with usually 5 to 10 employees, maybe less. There are lower contribution limits on this, but it's simpler in administration and it costs a business a whole lot less money. And usually when you've only got less than 10 employees, this is the way that which you'd want to go. But again, it's got to be through a business where the business sets it up. The money comes out directly through payroll. It's a simple IRA. Rollover IRA. This is the one that most people are familiar with when it comes to your 401k and you leave your job and the job says, take your 401k with you. What do you do with it? You've got options. You can roll it over in a new 401k or you can roll it over in an IRA. There's a 60-day window to move from one plan to another without incurring a penalty, aka taxes or early withdrawal fees. And the IRA is just set up to receive the money from the qualified plan. It is an excellent way for someone to get more options for investing. 401ks are usually limited to 10 to 30 investment options. Inside of an IRA, for the most part, you have an unlimited supply of investment options, which a lot of people like to take advantage of. And usually with an IRA, you can work with a financial professional to get some advice on how to handle that. Spousal IRA, we talked a little bit about this. Non-working spouse in 2023 can take a contribution into their IRA of up to $6,500 or $7,500 over age 50, as long as a couple files jointly and has enough income to cover the contribution. If you want to potentially limit your taxes, this is a great way to do it. And it's a nice incentive to, again, save for retirement. The government wants you to save for retirement. It helps to have people with funds so they don't have to rely upon the system as much as their own needs, wants, and wishes being fulfilled by their funds. Now let's get into a conversation about traditional versus Roth IRA. Traditional, tax-deferred growth. You've put the money in pre-tax, you don't pay taxes until you take it out. Roth, tax-free growth. You're taxed when you put it in as income. You're never taxed again when the money's taken out. Traditional, early distribution, subject to a penalty. There are exceptions. You want to talk to a professional about that. Distributions for a Roth, you can take out what you contributed because you've already been taxed without penalty. Again, there may be some exceptions. They're only going to tax you on the earnings if you take it out early. Traditional, there's no contributions after age 72. And there's also a required minimum distribution starting at age 72. In a Roth, you can contribute whenever you want, as long as you've got the income. There are adjusted gross income contribution limits for both. Got to look into those based upon your income. Traditional is taxable to beneficiaries. Qualified distributions, tax-free to owners, beneficiaries in the Roth. And again, there's a couple more things in here, but essentially the big one is tax deferred versus tax-free. Pay the taxes in the future or pay the taxes today. Where you're at in life is going to depend upon which one you want to choose. So again, the advantages, traditional IRA, they may be tax deductible, your contributions. It does help you save for the retirement. Again, it can reduce your taxes. Income on it is not taxed, or growth on it is not taxed until the money's withdrawn. Again, the contributions, tax deferred. Roth IRA, withdrawal of earnings are tax-free. Contributions can be made after age 72 if you've earned income that year. And the contribution eligibility is not restricted by active participation in an employer's retirement plan. Again, some things to consider. Contribution limits in 2023, $6,500 per person, additional $1,000 if you're over the age of 50. The big thing is you can't do $6,500 in a traditional and a Roth. It's $6,500 total. But you can split it up if you want. Give yourself some flexibility going forward. Hopefully you've learned a lot about what IRAs are. I know we went through some boring stuff with the government and how it came about. Some people find that really interesting. Hopefully you've learned about the different types. And if you have questions, feel free to reach out. Again, if you got some evaluations and tips for me, please point them out to me. I'll be happy to go through and make some improvements going forward. Again, in conclusion, hopefully the biggest thing you've learned is the sooner you start saving for your retirement, the better off you'll be. You want to compare your traditional versus Roth based upon your circumstances to figure out which one's best for you in order to save for your retirement. So again, hopefully you've learned a lot. This has been an insightful educational presentation for you. You've learned a lot, and now you understand a little bit more about individual retirement accounts.